Stock price slippage. How execution gaps impact your trading profits. Stock trading often looks simple from the outside. You click buy, you click sell, and the market executes your order instantly. However, real-world trading contains hidden frictions that can quietly eat into profits. One of the most misunderstood and underestimated of these frictions is stock price slippage. Whether you are a beginner investor or an active day trader, understanding slippage can dramatically improve your trading decisions and help you manage risk more effectively. Slippage is not a rare event or a technical glitch. It happens every single day in every market around the world. In fact, it is so common that professional traders build entire strategies around minimizing it. Stock price slippage refers to the difference between the expected price of a trade and the actual price at which the trade gets executed. When traders place an order, they typically see a price on the screen and assume they will receive that exact price. In reality, the market is constantly moving, and the price may change between the moment the order is placed and the moment it is filled. This difference can work against you or in your favor. When the execution price is worse than expected, it is called negative slippage. When the execution price is better than expected, it is known as positive slippage. Most traders focus on the negative side because that is where profits quietly disappear. Imagine seeing a stock trading at $50 and placing a buy order. If your order is filled at $50.05 instead, you have experienced slippage of 5 cents per share. That may seem tiny, but when multiplied across hundreds or thousands of shares and repeated over time, the impact becomes significant. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com. Use code BLOG to receive 20% off your next purchase. The stock market is a fast-moving auction system driven by supply and demand. Prices change every second because buyers and sellers are constantly placing and canceling orders. Slippage occurs because your order must find a matching counterparty in this dynamic environment. One major reason slippage happens is market volatility. When prices move quickly, the available price at the moment you place your order may disappear before the order reaches the exchange. By the time the order arrives, the next available price may be higher or lower. Another reason is liquidity, which refers to how many buyers and sellers exist for a stock at any given moment. Highly liquid stocks like major tech companies usually have small slippage because many orders are waiting to be filled. Low liquidity stocks, on the other hand, often experience larger slippage because fewer participants are available to take the other side of a trade. The type of order you use plays a major role in how much slippage you experience. Many beginners rely heavily on market orders, which tell the broker to execute the trade immediately at the best available price. While this guarantees execution, it does not guarantee the price. Market orders are the biggest contributors to slippage because they prioritize speed over price. When the market moves quickly, your order may be filled at a series of different prices as the system searches for available sellers or buyers. By contrast, limit orders allow traders to set a maximum price they are willing to pay or a minimum price they are willing to accept. This helps control slippage but introduces the risk that the order might not be filled at all. Not all slippage is bad. Positive slippage occurs when the market moves in your favor during execution. For example, if you place a buy order at $50 and it executes at $49.95, you receive a better deal than expected. This can happen in fast-moving markets when prices briefly dip. However, traders tend to experience negative slippage more often because sudden price spikes or drops usually occur when large orders enter the market. When many traders rush to buy or sell at the same time, prices can jump quickly, leaving late orders with worse execution. Over time, even small amounts of negative slippage can accumulate into a noticeable reduction in trading performance. Slippage acts like an invisible fee. Unlike commissions, which are clearly displayed, slippage happens quietly in the background. Many traders underestimate how much it costs them each year. Consider a trader who places 200 trades per year and experiences an average slippage of 3 cents per share on 500 shares per trade. That small difference equals $3,000 lost annually. Over a decade, that becomes $30,000 in lost capital. This is why professional traders track execution quality as carefully as they track profits and losses. Stock price slippage example. Let's walk through a detailed real-world scenario to understand how slippage works in practice. Imagine a trader named Alex who is actively watching a stock trading at $100. The company just released strong earnings, and the stock is starting to move quickly. Alex decides to buy 1,000 shares using a market order because he wants to enter the trade immediately. At the moment Alex clicks the buy button, the order book looks like this. There are sellers offering 300 shares at $100, 400 shares at $100.10, and 500 shares at $100.20. Alex's order for 1,000 shares must be filled using the available sellers. The first 300 shares are purchased at $100. The next 400 shares are purchased at $100.10. The remaining 300 shares are purchased at $100.20. The average execution price becomes $100.11 per share instead of the expected $100. This results in slippage of 11 cents per share. Across 1,000 shares, Alex pays an extra $110 simply due to order execution. Now imagine Alex later sells the stock and experiences similar slippage on the exit. The combined effect could easily exceed $200 in a single trade. Slippage is especially common during the first and last minutes of the trading day. The market open is one of the most volatile times because overnight news causes traders to react simultaneously. Prices can jump dramatically between seconds, making precise execution difficult. Major economic announcements, earnings releases, and geopolitical news can also trigger sudden price movements. During these moments, the gap between expected and executed price can widen significantly. Many experienced traders avoid placing market orders during these high volatility windows unless speed is absolutely essential. Liquidity is one of the most important factors influencing slippage. Stocks with high trading volume usually have tight bid-ask spreads and plenty of orders waiting to be filled. This reduces the chance of large price jumps during execution. Small cap stocks and penny stocks often have lower liquidity, meaning fewer buyers and sellers. A single large order can move the price significantly, causing substantial slippage. This is why institutional traders break large orders into smaller pieces and execute them gradually. Slippage also has a psychological effect. Traders may blame themselves for poor timing when the real issue was execution quality. This can lead to frustration and impulsive decision-making. Understanding slippage helps traders focus on what they can control. Instead of chasing perfect entry points, they learn to factor execution costs into their strategy. This mindset shift is essential for long-term success in the market. Reducing slippage is about improving execution rather than predicting the market. Using limit orders instead of market orders is one of the most effective methods. Trading during periods of high liquidity and avoiding major news releases can also help. Breaking large trades into smaller orders reduces market impact and allows the trader to average into positions more efficiently. Over time, these small adjustments can significantly improve overall trading performance. Long-term investors often experience less slippage because they trade less frequently and hold positions for extended periods. Small execution differences matter less when a position is held for years. Day traders and scalpers, however, rely on small price movements for profit. For them, Slippage can make or break a strategy. Even a few cents of unexpected price movement can erase the edge of a short-term trade. Understanding this difference helps traders choose strategies that match their time horizon. Advancements in trading technology have reduced slippage compared to decades ago, but it still exists. High-frequency trading firms use advanced algorithms to capture tiny price differences, making the market more competitive. Retail traders must rely on smart order placement and discipline to compete effectively in this fast-paced environment. Conclusion: stock price slippage is one of the most important yet overlooked aspects of trading. It represents the difference between the price you expect and the price you actually receive. While it may seem small on a single trade, its long-term impact can be substantial. Slippage occurs due to volatility, liquidity, order types, and market timing, and it affects both beginner and professional traders alike. By understanding how and why slippage happens, traders can make smarter decisions, improve execution, and protect their profits over time. Learning to manage slippage is not just a technical skill, it is a crucial step toward becoming a more disciplined and successful investor. Thank you for watching.